Hello everyone, welcome to Diplomatic Briefing. The China-US trade relationship seems less tense, especially with a consensus emerging on the TikTok issue. Leaders of China and the US have spoken, further stabilizing bilateral relations. I believe both sides seek a face-to-face meeting between leaders to review recent developments. After months of confrontation, the general perception is that China is not in a hurry, while the US is quite anxious. Besides holding the trump card of rare earths, China has made thorough plans in many areas, leaving itself enough flexibility to engage in a prolonged battle with the US. Take the US agricultural sector, particularly the soybean game, as an example. China has shown how well prepared it is. Autumn is traditionally the peak season for US soybean sales, but now, with more than half the harvest season over, the ongoing stagnation in China-US trade talks has led to a drop in exports. Meanwhile, South American competitors have seized the opportunity to fill the market gap. American farmers are facing the loss of billions of dollars in soybean sales to China. In North Dakota, one of the main agricultural states, industry associations and economists say that the Trump administration has yet to make progress on trade with China, and China has not made any commitments to purchase soybeans. This is a key factor dragging down the agricultural economy. Analysts point out that China had already expanded its soybean reserves before Trump took office. Unlike the US, which faces complex political pressures, China is very good at fighting a war of attrition. In addition, the agricultural subsidies promised in US legislation cannot provide timely relief for the current plight of farmers. According to a report by the North Dakota Observer on September 14th, North Dakota's soybean industry is highly dependent on exports to China, but so far Chinese buyers have been slow to place orders. Scott Yeaman, a board member of the Soybean Growers Association and a farmer himself, recently hosted a Chinese trade delegation. He believes that Chinese buyers are willing to do business with them, but at present the price of American soybeans is higher than that of Brazil. Foreign media have noticed that more and more Chinese companies are turning to Brazil to purchase soybeans and are increasing their investment in Brazil's agricultural heartland infrastructure. Over the past decade, China has invested heavily in Brazil's warehouses, railways, ports, and other infrastructure to facilitate the shipment of more Brazilian agricultural products onto ships bound for China. Last year, Brazil supplied 70% of China's soybean imports, which is double the amount from 15 years ago. John Newton, who has long been engaged in agricultural economic research and is also the president of an agricultural credit services company, said, "It is still unclear how long China can continue to rely on Brazil as its main soybean supplier," but he pointed out that before Trump took office, China had already accumulated a large stockpile of soybeans. In theory, China could meet its soybean needs by consuming its reserves and then purchasing more from Brazil. However, he said this approach cannot be sustained in the long term and may only apply to this crop season. Nevertheless, Newton also mentioned that China is very good at playing the long game because, unlike the United States, China does not have to deal with complex domestic political pressures. He noted that the US Supreme Court will hold a hearing and make a ruling in November on the legality of Trump's tariff policies, and the outcome could have an impact on US-China trade negotiations. If the tariffs are ruled illegal, many of the Trump administration's bargaining chips will disappear. Long Hu Jiman mentioned that China's temporary halt on importing US soybeans is only bringing other changes to the overall soybean market. He said that some Southeast Asian countries that might have originally purchased soybeans from Brazil are now starting to buy some US soybeans. However, farmers in North Dakota are not benefiting because the soybeans they ship to Asia usually have to be transshipped through ports on the Pacific coast in the northwestern United States. According to reports from US agricultural states, there are a few observations. First, international trade operates according to a set of established rules, and once a stable supply chain is disrupted, it is not so easy to rebuild. For example, North Dakota. Why are almost all of North Dakota's soybeans shipped to China? Because China has this demand and the purchase volume is large enough to form a dedicated transportation and supply route. As a result, stakeholders in various countries have been able to maintain stable cost effectiveness over the long term. But now, under Trump, When demanding that Asian countries buy American soybeans to replace Chinese imports, it's hard to say whether the volume can be made up. The key issue is that shipping these soybeans to various Asian countries separately would be much more expensive, making it impossible to maintain the original cost-effectiveness. American farmers and traders would all suffer losses. This is also where the huge appeal of the Chinese market lies. Secondly, Trump's insistence on launching a tariff war faces significant domestic resistance, resulting in even more instability and making it impossible to talk about any long-term strategy. In the end, whichever stakeholder complains the loudest, Trump changes his policy, making the US appear passive in external negotiations. This is a clear difference between China and the US. Thirdly, the importance of China's long-term planning. American agricultural experts state China has thoroughly prepared, planning alternative soybean import sources, ready to compete with the US for years if needed. Though American experts don't believe China can reduce long-term US soybean purchases, Chinese companies' investments in Brazil suggest they're reshaping the supply chain to focus on South America. Why wouldn't China reduce US purchases? It is believed that these are merely wishful thinking on the part of the American agricultural sector. China's rise has upended American perceptions in many areas. Recently, the South China Morning Post published an article that observed global economic trends through the lens of a robotic vacuum cleaner product. Mainland China's Observer Network pointed out that there was a time when digital robots were seen as a symbol of American success. Scientists at the Massachusetts Institute of Technology in the US developed this type of small household appliance, and in 1990, they founded a company called iRobot. However, after 30 years, the United States has completely lost control over the market it once pioneered. Similar to many other industries worldwide, Chinese companies have now become the dominant players in the field of digital robots. According to a report by the South China Morning Post on the 20th, a recent tracking report released by the market research firm International Data Corporation shows that in the second quarter of 2025, the world's top 5 digital robot manufacturers will all be Chinese companies. These are Roborock, Ecovacs, Dream, Xiaomi, and Yunqiong Intelligence. Together, these 5 companies account for nearly 70% of the global market share. The report believes that the process by which Chinese companies have caught up with and replaced their American competitors largely reflects the current state of the global economy. It is noted that the national brand Roborock has established a presence in many countries, including Northern Europe, Germany, South Korea, and Turkey, among others. Its overseas shipments consistently rank at the top, especially in the Turkish market. Their market share has exceeded 50%. In the North American market, Roborock's shipments increased by 65.3% year-on-year, with business coverage in over 700 cities. Meanwhile, Ecovac's shipments grew by 35.9% year-on-year. While maintaining a leading position in the domestic market and leveraging its offline retail advantages, its international market share steadily rose to 14.1%. Dream secured the top spot in the European market with a 25.5% market share. Firstly, there was also strong growth in the Middle East, Africa, and North American markets. Xiaomi maintained a stable market share in the mid-range segment, especially in emerging markets, where it continued to strengthen its market position by leveraging brand recognition, high-cost performance, and a comprehensive distribution network. 3i Intelligent entered the global top 5 for the first time with an 8.5% market share, continuously expanding its international business footprint by focusing on regions with low penetration rates and adopting differentiated market strategies. Meanwhile, the leading American brand iRobot was forced down to 6th place. For American companies, this market loss has come at a heavy price. According to IDC data, the digital robot market is growing rapidly, with global shipments in the first half of this year increasing by 33% year-on-year to reach 15.35 million units. However, the rise of Chinese brands is not due to price advantages. In Amazon's US store, Chinese brands are priced similarly to American brands. In mid-September this year, an iRobot digital robot was priced at just $165, actually making it one of the lowest-priced products on the market. Claire Zhao, a senior analyst at ITC China, believes that the success of Chinese brands lies in their focus on marketing promotion and R&D innovation. They are making significant new investments in innovation. In the report, it is stated that Chinese companies have achieved remarkable results in overseas markets, rapidly increasing sales and brand awareness through e-commerce. The rapid iteration of technology has directly enhanced product competitiveness and user loyalty. Claire Zhao also mentioned that these leading manufacturers are continuously expanding their product portfolios to cover a wider range of robotic cleaning solutions and traditional home appliance categories, even integrating into broader smart home ecosystems. Chinese brands are making a strong push into the US and European markets, where the penetration rate of robot vacuum cleaners is much higher than in China. As more players enter the market, fierce competition is forcing all companies to develop and launch new products at an unprecedented pace. Major brands are focusing on developing high-tech, high-end products. Investment in R&D has thus become the key variable for Chinese brands to break through. For example, according to the financial report of FOSS, the company's R&D expenditure increased from 549 million yuan in 2021 to 1.34 billion yuan in the first 3 quarters of 2024. Last year, Roborock's R&D investment also reached 971 million yuan, accounting for 8.1% of its total revenue. Last week, at the first Guangdong Premium Products exhibition held in Guangzhou, Janet Su, a sales manager at a Guangdong home appliance manufacturer, said that the new generation of digital robots developed by Chinese manufacturers are already equipped with advanced artificial intelligence and mechanical backup functions. Chinese companies compete with each other to launch new products, with product cycles as short as once per quarter and rarely exceeding half a year. According to data from Tianfeng Securities, currently, only about 5% of households in China own digital robots, while in the United States this proportion is around 15%. Given the enormous potential for future market growth, new players continue to enter the field. Claire Zhao also mentioned in her report that the entry of new players highlights the intensifying competition in the sector. Nevertheless, the global penetration rate of digital robots remains relatively low, especially in emerging markets where there are still significant growth opportunities. It is expected that, driven by advances in AI technology and the integration of mechanical backup and other robot functions, the industry will continue to maintain its growth momentum. Americans invented digital robots, but why is it that China has come to dominate the field? In response to this question, it can be summarized as follows. China's highly market-oriented environment and the comprehensive commitment of its enterprises to technological innovation and competition have allowed China to overtake others through genuine technological breakthroughs and advantages in the industrial supply chain. This is not simply a matter of copying. Just like with air conditioners and photocopiers in the past, China ultimately managed to make products that were better suited and more affordable for Southeast Asian markets. China is able to achieve this because it has a complete supply chain, rapid product iteration capabilities, and, combined with huge market demand, enables Chinese companies to create products that better